D.E. Shaw, the $50 billion hedge fund that in recent years has engaged in shareholder activism along with its many other disciplines, will today make public something the market has already known for weeks. It has a more than 1% position in Emerson Electric and is embarking on a campaign to bring significant change to the industrial giant that includes asking the company to split its industrial automation business from its climate technology business while embarking on a significant effort to cut costs. While Emerson's stock price has already responded recently to stories of D.E. Shaw's potential activism, its release today of a voluminous report outlining all the ways in which Emerson has failed shareholders over the last decade is its first public utterance since the reports of its potential activism first surfaced. Now, the report offers a searing indictment of Emerson's longtime CEO, David Farr, and of its board of directors, who have presided over a significant shortfall in total shareholder return over the last 3, 5, and 10 years when measured against Emerson's peers in the automation or HVAC industries, not to mention a 10-year lag of roughly 120% versus the S&P. D.E. Shaw focuses on what it says is a history of poor capital allocation by the company since Farr took over as CEO. Since 2000, Emerson has spent nearly $14 billion of capital when accounting for M&A and CapEx, but it's only increased its EBITDA by $400 million over that period when accounting for its capital expenditures. The resulting 3% pre-tax return on incremental capital severely lags almost every one of its peers who post an average return of 11.4% during that same time period. Now, one culprit for those poor returns on capital D.E. Shaw maintains is a cost structure that includes the highest levels of SG&A relative to sales amongst its peers and the lowest revenue per employee versus those same peers and a broader universe of industrial companies. For example, the report cites Emerson's 18 different facilities in the city of Houston, of one area that could be used to reduce cost. Another, the company's aviation department. That includes 8 airplanes, 1 helicopter, and a staff of 40 people. They also have their own internship program at the aviation department. Emerson CEO Farr has long been lauded as a consummate industrialist, and his retail shareholder base has stood by him, given a dividend that has increased every year of his term. D.E. Shaw claims, though, he's been overcompensated for that track record, with pay of $150 million over the last 10 years, 50% more than the S&P 500 average, despite shareholder returns that have lagged that index by 118%. They also note that Mr. Farr has been compensated over $300,000 annually in perks related to his personal use of the company's jets. To put that in perspective, that's 5 times more than the average for Emerson's peers in terms of how much they use the plane. They do it based on what a first-class ticket would cost and above that. They want Emerson to change its metrics, by the way, for long-term incentive compensation, which are solely focused on EPS and free cash flow growth. And they want them to include indicators such as return on invested capital and total shareholder return. Now, these are metrics that are widely used by Emerson's peers. As well, they're asking the company to unstagger its board of directors so that all directors come up for a vote every year. And they note, by the way, the board, apart from Mr. Farr, owns only 0.04% of the company's stock. And there have been only 3 open market purchases by board members over the last 10 years. By the way, 4 board members are currently up for election, including Mr. Farr. The window for filing a proxy closes November 6th. Now, none of this, in terms of arguments, means D.E. Shaw is going to get what it wants. It is a relative newcomer to activism. It owns only a 1% or so stake. And while it may say it's ready to endure a proxy fight for board seats, it remains unclear whether it will do so. As well, the track record for creating value from company splits, well, that remains far from clear. Of course, consider DuPont. We've talked about it a lot here. Years of activism from Trian and Third Point succeeded in getting a split, but that is yet to create real value. On October 1st, soon after reports of D.E. Shaw's interests were reported, Emerson said it began a review of the company's operational, capital allocation, and portfolio issues. Guys, we'll keep an eye on this one, but it could be an interesting fight given the window closes in only a few weeks.
It sounds like an activist campaign in the old style, where you identify this company that has a little bit of a complacent shareholder base, I would argue, very much a popular individual investor holding because of the dividends and things like that, and you can identify how it's just been the suboptimal performer and just not managed for, you know, kind of a lean and mean type performance.
Yeah, I think their focus on costs, which they say that could be reduced by as much as $1 billion. They took a look at it from both top down and bottom up. The lack of productivity per employee. Of course, you are talking when you get into that, and sometimes it overlaps with sort of politics in terms of would they want there to be layoffs and things of that nature. The plane, though, always resonates, I think. Why you need 8 airplanes and 1 helicopter when none of their competitors have anywhere near that, and 40 employees in your aviation department. It costs about $25 million a year, at least according to D.E. Shaw, to run that. That is something I think that certainly some shareholders may question as well.
Of course, the company has a fascinating history. Back in the 90s, they were known for never letting net income go down year on year. Their old CEO, Chuck Knight, that was his hallmark, right?
And
it's a legacy in the days of Tyco, when Tyco was taking an alternate strategy.
And you know, Carl, they still, I mean, the compensation, as I said, the incentive plan is still based on EPS growth being, I think they wanted to be 300 basis points above GDP. That's what they're looking for. If they hit that metric, that 60% of the incentive pay goes to them. Many of the other companies that they compete against are looking at a lot of different metrics. And you do wonder, because you can get EPS growth, but it doesn't mean you're getting a return on invested capital. It doesn't mean you're hitting a lot of other things. You can pay 20 times EBITDA for a company like Rockwell, which they went after and failed to get. It doesn't mean you're necessarily going to really create long-term value.
And buy back a bunch of stock or whatever
Exactly,
else.
yes.